If you're a Gen Xer, which by the way, that means you were born between the mid-1960s to 1980, there is a good chance that you have a retirement account. A matter of fact, you may have multiple retirement accounts. There's also a good chance that when you chose the funds for those accounts, you said, Eeny, Meeny, Miny Moe. Pick a fund and hope it grows. I know that's what I did. Well, it's just insane. There's so little education out there to guide us on this financial journey, which is why 60% of people with self-directed retirement accounts are not confident about their investment decisions. How to invest the money you're contributing to your retirement account is one of the most important decisions you must make. And what you choose determines the rate at which your account has the potential to grow and the amount of income you'll be able to withdraw in retirement. It can just be overwhelming. Goodness gracious, so many options. Don't fret. Whether you are just getting started or you've been invested for 5-10 years, now is a good time to go back and reevaluate those decisions that you made way back when. And today I'm going to give you 6 recommendations for consideration when choosing funds in your retirement accounts. Number 1, determine how much volatility you can stomach. This is your personal risk tolerance. The stock market is like a thrilling roller coaster ride. It goes up, it goes down, and you have to be the one to determine how much of this volatility you can handle. There are plenty of free risk tolerance assessments online to help you assess your comfort with risk. Number 2, identify your goals. You want to make sure to invest in products that align with your goals. So for instance, maybe you are 10 to 15, 20 years from retirement and you are investing for significant growth in your portfolio. You want to make sure you have products that align with that growth that you're expecting. If you are just 5 to 8 years from retirement, you may want to preserve assets and invest more conservatively. It's important that you identify your goals at the start. Number 3, understand basic investment types. And we're going to keep this really simple, Gen Xers. So there are what we call stock funds. Unlike an individual stock, a stock fund represents a basket of partial ownership in publicly traded companies. So I want you to think you would own maybe a little slice of Apple, a bit of Coca-Cola, a little bit of PayPal or Walmart, all in this one basket, one fund. Of course, it depends on the type of fund. And then you have what is called a bond fund. Now, first, a bond. Unlike stocks, a bond does not give you ownership. You don't own it. You are simply making a loan to the government or to a company, and in exchange, they're going to pay you back with interest. If you have a bond fund, then you have a collection of bonds all in this one fund. It could be corporate bonds, government bonds, international, different types of bonds. And then finally, combination funds. Combination funds is a mixture of stocks and bonds. Number 4, what companies comprise the fund? Do a little research. Find out the fund's holdings. That's all of the companies that make up a particular fund. You can find this on either the fund fact sheet or what's called the fund prospectus. Both will give you information on the companies that make up a particular fund. Now, I would advise that you not select a fund that contains a bunch of companies that you are completely unfamiliar with, industries that are totally foreign to you. You want to have a basic, at least surface level of understanding of the funds that you select. Number 5, assess the fees. That's right, funds come with a cost, and your goal is to keep those costs as low as possible. Now, between administrative fees, sales, commissions, this cost has the potential to drastically eat away at your returns. The more you pay, the less you get. And so you definitely want to check out the fees. Number 6, evaluate the fund's performance. Now, you may be inclined to look at how that fund performed performed over the last 6 months or the last year. And if that fund was doing really well, hey, you'll select that fund. But a better gauge is to look at performance over time. Look at that fund's performance over the past 5 years, even 10 years, before making your decision. You may even want to look at the worst year and then ask yourself, if that were to happen again, would you be able to tolerate it? This is a good question to ask before selecting a particular fund. Parting words, fellow Gen Xers. No one should know more about your money than you. So even if you're working with a financial professional, make sure that you become knowledgeable. Find out what fees are you paying and how will that impact your actual returns. How have your investments been performing over time? And how are you invested if you're not even sure? Get in the driver's seat, my fellow Gen Xers. And if you haven't started, it's never too late to start investing. I'll see you next Monday at Gen X Money Moves.